Can America save Europe? That's the question that investors have been asking this week as America, in the form of the Federal Reserve, that's the American Central Bank, has appeared to ride to the rescue of one bank in particular, the European Central Bank. Okay? It's not the first time that question's been asked historically, can the Americans save Europe? But I think what's happened is America has watched in despair as European politicians have faffed around trying to deal with a succession of states going bust. They've seen the Euro project under threat, and they've thought, well, such a massive trading zone, we can't let this happen. So let's knock some heads together. Let's get our fellow central banks around a table and agree some kind of plan of attack that allows the Fed in to help European central banks. So what we're going to do on this video is cover what the Fed's done and will it work? What's the effect been so far? What's the likely medium long-term effect? Now, two things to note about this video first of all. Number one, this is not an economics degree course and it's not a job application to the Federal Reserve. All right, I'm going to cover all the basics in a jargon-free introductory way that hopefully will mean at the end of it you understand a little bit more about what all the newspapers are ranting about this week. Okay? And the second thing is I'm going to specifically focus on the Fed's action with other predominantly European central banks. This is not a video about Operation Twist or quantitative easing. For those, see my other videos, and there are titles that give the game away there. And I'm not going to look at what China's done either. That'll be a separate topic. Okay, so with those caveats in mind, let's go for it. The Federal Reserve has basically looked at Europe and said, I can see a big problem here. All right, and this problem comes through in various rates and spreads, and I cover those from a technical point of view in other videos. The Fed's looked at Europe and said there's a problem. The problem is fundamentally this. European banks are gradually stopping lending to each other. They're getting very, very nervous, and the reason for that is that no one trusts, to some extent, the euro currency and euro-denominated assets, and that's because banks in Europe went on a huge lending spree. The Greeks were borrowing, the Italians were borrowing, the Spanish were borrowing, everyone was borrowing, so lending to each other in euros, and now we're in a recession, or near as damn it, and suddenly people are thinking, well, what actually are those assets worth? Are we going to get those loans back? Are we going to be repaid? There's a huge nervousness, and that means that lending, particularly in the Eurozone, is becoming a bit of a problem. Banks just won't lend to each other, and if banks won't lend to each other, they won't lend to companies and consumers, and so on. And the Fed is worried that no less than a European enormous credit crunch is on the way. So what they've done is to say, well, we can't wait around any longer. Politicians are faff about until the euro's collapsed. They're fiddling while Rome and all the rest of Europe burns, if you like. So let's get the bankers round a table and try and sort something out. Okay, so what are the Federal Reserve doing? In essence, what they've done is this. Now, backdrop to what I'm about to say is that the dollar, remember, is the world's primary currency. Okay, that's still the case. More trades are conducted in US dollars than any other currency in the world. That means people need US dollars to pay for stuff. It means that many, many loans are denominated in dollars. So what the Fed said is, right, okay, what are we going to do? Let's try and make dollars more freely available in Europe. Okay, because people may not trust the euro, which is why it's been drifting downwards recently, but they do still have some faith in the greenback. All right, so if the dollar is the world's preeminent currency, let's make it a bit easier. As the Federal Reserve, as the central bank for the dollar, we should be able to do something that makes it at least a bit easier for banks in Europe to borrow dollars. Now, you might say, why aren't banks just going to the European Central Bank for emergency funding if that's what they need? I mean, after all, central banks can in theory print money. They can create it out of thin air. And the reason, partly, is stigma. People don't want to be seen. Commercial banks don't want to be seen to be going to central banks because it looks bad, okay? Because what it says is, I can't borrow from my fellow banks, so I'm kind of going to the backdoor facility at one of the central banks. And if word gets out that you're having to resort to borrowing from a central bank, all right, regardless of the rate, doesn't really matter, people will then write you off completely. So you must be desperate. So what the Fed's trying to do is say, right, let's talk to the ECB, set up a mechanism whereby the ECB can lend dollars so cheaply to European banks, all right, that no one's going to have a problem with it. It's going to be like a no-brainer because the interest rate, if you like, will be so low, why wouldn't you want to do it? So that's what they're trying to do. They're trying to bring the funding cost down, the cost of, if you like, going for one of these IOUs from the ECB in dollars. Now, how are they going to do that? Little bit of technical, not too much though. Okay, roughly speaking, here's the mechanism. Now, in theory, just to be clear, what I'm about to say, I could pick any two central banks from a list of 6, because the deal that's been done doesn't just involve the Fed and the European Central Bank, but frankly, no one cares about the other banks to some extent. That's the key relationship that matters, because it's Europe and the euro that the Fed is trying to sort of do something about, okay? But similar deals have been cut simultaneously with the Bank of England, the Bank of Canada, the Bank of Japan, and the National Bank of Switzerland, all right? But those almost are peripheral to the main point of this video. So, what's the deal? Something like this. So, if I put, say, the Federal Reserve, I'll just call them the Fed there, and I'll put really the other central bank they're trying to offer most assistance to there, that's the European Central Bank. I mean, in theory, what I'm about to say would work if I was talking about, Bank of Japan, Bank of England, except the currencies might be different. But here's the principle. What the Federal Reserve has basically said is, right, we will make dollars available in exchange for euros. It's called a swap. Now, I'm not going to worry about the technicalities of a swap too much in this video because I cover that in another video, but essentially what the Fed has said is the technical bit is the ECB can swap euros into dollars, and here's the key point: we're going to drop the interest rate that the ECB has to pay for those dollars. All right, and the principle is supposed to be this: if the ECB, that's the central bank in Europe, can borrow cheaper from the Fed by swapping euros for dollars. All right, it's like the Fed's become the kind of global pawnbroker of last resort, saying, come on, give us your dirty old euros, we'll give you brand spanking new dollars. All right, this is all done electronically, by the way, through computer systems, but that's by the by. What they've said is, we need to make this attractive so the ECB can then go out, and lend dollars to other institutions in the European market, banks for argument's sake, and make those nice and competitive. Interest rate question mark means, hopefully this is going to free up dollar loans to European institutions between it and the ECB. All right? So the principle is that this rate here has been lowered. Now, bit of technical jargon, which I'll explain in another video, so I'll keep it brief here. It's been not lowered, it's been slashed. All right? This rate used to be something called the overnight index swap rate. In a nutshell, that's an average of the rates that commercial institutions lend to each other. Okay? That used to be that rate, so it's kind of a market-driven rate, plus what they call 1%, or 100 basis points. So it's like a commercially agreed rate between the important institutions in the US market plus 1%. That plus 1% has been halved. Now it's the OIS rate, the overnight index swap rate, see my other video for more on that one, plus 50 basis points, which again, to strip out the jargon, means plus 0.5%. So that's a real discount, okay? So that means dollars can flow from here to here. Now, you might be thinking, does that mean speedboats crossing the Atlantic? No, it's all done electronically, okay? So dollars can flow from here to here, euros through a couple of swipes on a keyboard flow from here to here, and that means that dollars can go from there to there at a lower rate. And the rate should be low enough that these institutions don't feel embarrassed about going to the ECB. Someone says, well, I hear you're going to the ECB. It's dodgy, isn't it? They go, well, have you heard the rate? It's a no-brainer. Okay, so the stigma's taken away, and that is supposed to unlock the flow of currency, if you like, around Europe. It's supposed to instill confidence. Okay, now, couple of questions, really, couple of key questions. Number one, will this work? Okay, well, that's a really key question. So let's look at, what effect is this supposed to have? This move has, to some extent, boosted liquidity. What does that mean? Short term, it means, hopefully, that more currency, more dollars will be made available to European banks. Okay, remember, people trust the dollar. It's the world's biggest trading currency. A lot of IOUs are denominated in dollars, and the perception is they trust it, frankly, more than the euro. Okay, so more dollar funding will be available to European banks. That will increase confidence in the European banking system. That means that more loans will get made, banks will hopefully be less likely to go bust, and so on and so forth. Okay, so second effect it had was briefly, if nothing else, to boost the euro at the expense of the US dollar. And that's not difficult to understand if you think about it. The Fed has, through some cunning swipes on a keyboard, made dollars cheaper to get hold of. Okay, so that's going to decrease the price of a dollar. It's true of any asset if you think about it. And of course it gave a little boost to the euro at the same time. You know, the Fed riding to the rescue. Maybe the euro is more likely to survive, some would say. Thirdly, stock markets had a bit of a rally, to put it mildly. All right, bit of a boost to the stock market, and that's because primarily what this does, short term at least, is to boost confidence. And confidence in banking is a vital commodity. People thought, crikey, Federal Reserve is actually getting heads around a table, banging them together and saying, all right, let's release dollars into the European banking system. All right, let's almost put the politicians to one side who are faffing about trying to sort of glue together Greece, Italy and so on, and let's get on with making sure the banking system doesn't collapse. So people thinking, great, the Americans are on side, coming up with solutions, banging heads together in terms of other central banks to try and solve this liquidity crunch in Europe. And all that is great, and confidence caused stock markets to rise, gave a little boost to the euro, and so on. But here's the catch. None of it solves any of the structural problems in Europe. All right, this does not solve solvency. Right? Now, for anyone thinking these are just long words, what's the difference? How can you solve liquidity and not solve solvency? Well, solvency is ultimately more important. It's longer term. So, sorry, it says solvency there, for anyone who can't read my spidery writing. Have we done anything to improve solvency around the Eurozone? The answer is no. Now, if you're wondering what the difference is, and if you're confused by my swap example with the Fed, let's simplify it further. Imagine the Fed as a pawnbroker. All right, now how do pawnbrokers work? Well, if I went to a pawnbroker, I'd say, look, I'm desperate, I need $100. All right, and the pawnbroker, Federal Reserve, would say, right, I can give you $100 potentially, but I need some collateral, I need some security. Okay, what have you got? And I say, this watch. All right, and the pawnbroker, Federal Reserve in my example, looks at the watch and says, oh, that'll do. Yeah, short term, I will lend you $100, you come back with it in 3 months, all right, plus some interest, and you get your watch back. Okay, fine. That arrangement, short term, solves my liquidity problem, which is that I need $100 because I've got to pay off a debt. But if the watch that I handed over as security is worthless, all right, so when it's returned to me, I've still got a crappy asset, okay, that problem hasn't gone away, all right? The underlying asset that backs that whole transaction at a pawnbroker, all right, has basically not been changed. All right, so that's really one way to look at the European problem. That's the difference between liquidity and solvency. Yeah, the Fed can throw more dollars around Europe, all right, but that doesn't change for 1 second the fact there are lots of bad apples out there, lots of euro-denominated assets that are probably worth a fraction of what they're in banks' books at the moment, and there's still lots of concerns about where those bad apples sit in terms of which countries and which banks are sitting on them. Okay, so in summary, the Fed's come to the rescue, provided a bit of extra liquidity in Europe by an electronic sleight of hand. Still a massive question mark over the structural reforms needed to get Europe back on its feet. Certainly hasn't solved any of those problems. Gave the euro a short-term boost. Whether that lasts remains to be seen. Dollar slid again. All right, some people are getting a bit nervous about the sort of slide in the dollar caused by this kind of move. Stock markets rose briefly. Will that be sustained? Time will tell. And confidence was given a shot in the arm. Confidence is probably what they were trying to achieve. Basically, this is designed to say, well, even if you don't understand the basic mechanics, if you get 6 central banks around a table, all trying to solve the same problem at the same time, at the very least, it sends out a message to banks and consumers and companies that some big players realise the seriousness of the problem and are prepared to take coordinated action to try and solve it.